I'm going to go over some dividend stocks that I think are quite attractive with some pretty high yields. So this first stock is ticker symbol GSL. This company has a 5.5% dividend yield. And check out that payout ratio in the middle there. They're not lying. They only have a 17% payout ratio for a 5.5% dividend yield. This is one of those shipping companies. They ship a bunch of, containers over the sea and stuff. And the stock has done great. It's actually nearly at an all-time high. The stock's at an all-time high, and the stock chart doesn't even include the reinvested dividend. But here's how we can tell if this 5.5% dividend is actually safe on this company. In my opinion, it totally is. So check out their net income right here, their bottom line. They net 95 to 100 million of net income a quarter. So let's go see how much a dividend costs. So they're easily doing, call it 95 mil of net income a quarter. Well, they pay a dividend. That 5.5% dividend only cost, and this is the number exactly, $21 million. So this company certainly, in my opinion, has a very safe dividend. It only costs $21 million. Yeah, if we go to this company's website right here, one other thing to be aware of, this company doesn't pay taxes because of where they're located. But yeah, like I said, it's one of those shipping container companies. They benefit from supply chain issues. This is like the way more better purchase than a Zim, in my opinion. A lot of people hype up ticker symbol ZIM. They also have a high dividend yield, but that one's not nearly as quality. So here's Zim right here, pretty much, not at all-time highs, kind of like that other company is. And this company's net income is way more choppy. Check this out. Like, it consistently is sometimes negative. So I always will recommend GSL over that one in the stock price. You'll get some good stock price appreciation potentially as well. So yeah, look how more consistent this company's net income is. I mean, they're even on a bad year, like 67 million well covers the and look at this. We can go all back to 2021. They always make over 50 to like 100 mil in net income a quarter, and it's only gotten better this past year. So that's a cool one. Or actually, we can look at the net income to common holders. There's an insider taking a little bit of profits here. But anyway, dividends, super safe in my opinion. That's the first stock if you're looking for a bit of a higher yielder. So next up, the other company I want to go over is actually ticker symbol. Let's go over this one. MDLZ. This is Mondelez. They own so many great brands like Toblerone, Oreo, Cadbury. There's partnerships. They have partnerships with McDonald's as well. They're just one of the food companies that are being hit. Just like if you look at Pepsi, Hershey, a lot of these food names, General Mills, the charts look very similar. But this one, in my opinion, is one of the more quality buys if I was going to buy the dip on a food stock right now. They traded a 19 forward PE. The market cap is 71 billion. I actually want to pull up their website. Oh, and look at this yield, a 3.5% dividend yield, safe 50% payout ratio. So yeah, if we go to Mondelez right here, I guess, they're trying to get my cookies right here. They own a bunch of popular food brands like Oreo, Chips Ahoy, and that kind of stuff. So yeah, biscuits and baked goods are 49% of their revenue. Then chocolate, like a lot of people's favorite chocolate is Toblerone. This one's actually done great. It's at a record of 10% year over year, after grew 8%, after grew 15%. I guess they sell gum and candy as well. That one's kind of a flat grower. But it's cheese and groceries, so they're a grocery store. Baked biscuits, that's up 4% year over year. So anyway, if we go to their bottom line, they're easily making every quarter around like 500 million to $1 billion. And like that one quarter Q4 is really real. They really did make like 1.7 billion in net income. So let's go see how much a dividend costs. So they're easily making, if we average it out here, like, I don't know, 800 mil of net income a quarter, maybe a little more. Let's see, the dividend cost 609 million. And why is the cost of the dividend going down? Because they're also doing a lot of share buybacks since they have a lot of room on top of that. So this company doing buybacks, 3.5% dividend, and they have some great brands. You just want to, I think the risk to reward is pretty good to buy this one. It's at a 19 PE, a lot of great names there. So yeah, here's actually a REIT. This is ticker symbol CTRE. It has the best balance sheet for a REIT I've ever seen. I've looked at all the REITs out there that exist, like literally. And this one, if you buy it right now, even at its current price, you're going to get 3.5% of your money back just in a dividend every year. And that dividend is super safe. And why is the dividend kind of abnormally high? That's because this one's a REIT. They kind of have to, by law, pay out 90% of their taxable income. And they've had great stock price appreciation, but let's judge them off their financials and the fundamentals, and this looks incredible. The revenue growth is some of the best I've seen. It's up 71% after it grew 38%. And this is a triple net lease hospital kind of senior housing REIT. incredible net margins of 55%. And you really look at the revenue, it was 132 and they netted 75 mil. You really don't look at the net income for REITs because it doesn't include the depreciation and the amortization. So you really look at the core FFO, which is this number right here. Say that's what you do a dividend payout ratio of. But even if we don't give them the benefit of the doubt and just do a dividend payout ratio off their net income, they made 75 mil in net income, and look at this fortress balance sheet. I mean, so incredible. The assets are growing, liabilities are staying the same, but let's go see how much the dividend costs. You should use this number. So they really made 100 mil, and let's go see how much the dividend costs from that. Dividend cost 67 million in the most recent quarter. So they can easily afford the dividend. Super great balance sheet. And it's in a bit of a more growthy sector right now. These senior housing facilities, they own some great assets. I made a video about them a long time ago. Actually, let me go back to them real quick. I think if we go to the comments right here. Yeah, I made it a long time ago. Well, actually not that long ago. I made a video going over these REITs right here, full more analysis if you want to go to one of my previous videos. Let's actually look at Cal Maine right here. This company I do own, and it's actually one of the dividend stocks I want to go over in this video. For the fundamentals are so great on this one, but they're a commodity stock. They literally have the largest market share for chicken eggs in the US. That's all they do. They just sell chicken eggs, pure commodity, and the price has been very volatile. I am down on this company. I'm down 9% on this company, so not too great on this one. But let me tell you why this one might be a decent risk to reward to buy now. Not a super great risk to reward, because if we look at this forward PE, they're at a 20 forward PE, which is a little expensive. But when we do an X cash PE multiple, let me show you a few things I love about this company. Check out the market cap in the top right. They're worth $3.5 billion. That's how much the whole company is worth. And check out their balance sheet. They actually have 1.14 billion in cash and no debt. So they have over 20 to 25% of the entire company of what you're paying is just their net cash on hand. But yeah, check this out. As we know, chicken eggs prices are starting to normalize. So this is tough comps, obviously, but revenue's down 19% year over year, but they still made 102 mil of net income. This company actually changes their dividend every quarter. They have a rule where they pay out 30% of the net income they make. So if we look at the dividend payouts, it changes every quarter. But yeah, currently they have a 11.7% dividend yield, and and if we look at the payout ratio based off the last full year, it's a 27%, but obviously that changes. So anyway, yeah, conventional shell egg sales, specialty egg sales, prepared food. Yeah, they're really getting a prepared food. So that revenue is like great, like new revenue stream driver. They did beat on EPS this quarter. They beat on net income and on EBIT. So the margins are actually holding up stronger than they thought. So anyway, the next time there's a bird flu or burning of egg plants, whatever, this is your way to really benefit from that. Again, pure commodity. You don't want to have these commodity stocks as like meaningful size positions in your portfolio. So that's another one that I do own. I am pretty down bad on them. This is Iron Mountain right here. I do own this one as well. A lot of the interest rate sensitive stocks have been booming. Where's Iron Mountain? So yeah, Iron Mountain right here. So they're a great dividend payer. This is another REIT, and this is specifically a data center REIT. And they have a rule where they keep their dividend payout ratio in the mid 60%. That's what they always target, and it's always been around there. So you get a 3.44% dividend. It's actually higher than that. Actually, I think the yield, a 3.87, yeah. So they have a basically call it a 4% dividend yield because they're going to raise it. So they have a 4% dividend yield. What's really been booming is their data center business. Check out these year-over-year growth rates. This is what you want to see. It's up 33%, after grew 20, after grew 27, after grew 30. So it's just been literally hits a new record every year, every quarter. Then they have this other corporate and other. Check out, that one's also at a new record this quarter, up 46%, after grew 85%. So that's what the kind of growth you want to see. Again, you don't look at net income for REITs, especially this one, because it doesn't include the depreciation and the amortization of these real estate assets. So you always look at the CFO, the core FFO, the AFFO, which is basically this number down here. So they're making on average, call it, some quarters it's really good, but let's just say 300 million a quarter. So they're making 300 million a quarter. Let's go see how much a dividend costs. So it costs 231 million. So really safe dividend there. And if you go to the website, there's so much future growth potential on this one. They've actually been one of the best performing REITs. This doesn't even include their dividend. This stock looks even better Like if like look at the stock price appreciation that it had. I mean, it just didn't go down because it's in the it's so growthy, and the data center business is booming. So yeah, that's why I picked up 4 shares of this one. I just like the growth. I like the numbers of what I've seen there. So yeah, that's Iron Mountain. So here's a stock that has a 3% dividend. Again, this it's actually a little higher than this because they just wrote their dividend. They have like a 3.1% dividend yield. But I think on top of this, this stock will give you 3 to 4% in stock price appreciation every year for a total return of around 8% with ABBV. And let me show you why I think that. If we look at the forward PE on this one, they had a one-time adjustment from like they had a schizophrenia prescription that had made their net income tank, but it was a one-time adjustment. If we go to their forward PE, they're at a 26 forward PE, which is pretty fair. That's not a crazy forward valuation, 26. And what does this company do? They sell a bunch of different prescriptions. Like Skyrizi, for example, has been growing like a beast. And this is why I think they're going to continue to give 3 to 4% in stock price appreciation on top of that 3% dividend. So this revenue is up 46% year over year, after grew 50, after grew 52, after grew 85. I mean, it just hits a new record every year, every quarter. This is the trend of what you want to see. And I'll tell you, that's just one of their prescriptions. Like, let's go to their next biggest one, which is 14% of the business, Rinvoq, or I don't know how you pronounce it, but that's up 35%. After grew 45, after grew 59, after grew 56. I mean, this is the kind of growth that you want to see, and that's why I trust this one. Like Botox Therapeutics, whatever this is, it's almost at $1 billion for the first time ever, and it just all in the middle here, just positive year-over-year comps. So that's what I like about ABBV at a 26 forward PE, a 3.1% dividend yield, and on my opinion, you should get 3 to 4% stock price appreciation. I'm totally biased because I did just buy this one, I'm up 0.5%, but I got 3 shares of ABBV now. That's my healthcare play. If you want exposure to some of these prescriptions, I think there's some news about them doing acquisitions, or Healthcare Canada approves AbbVie's, where is this? Okay, full year EPS revised to $9.90 to $9.94. So basically call it $10 of EPS, and it's a $220 stock. So that's actually a 22 PE. Simple math, if they make $10 of earnings, it's a $220 stock. 22 PE, forward PE potentially. Anywho, that's AbbVie right there. Oh, hey, you know what? I wasn't going to talk about ClearSecure, but that's another kind of higher yielder. Let's actually check out. Okay, so actually not too high of a yield, a 1.4% dividend yield. This one is that airport company. Well, not actually. They're the digital scanner, like that lets you skip the lines in the airports. They just make good money, in my opinion. We can see the revenue is just up and to the right, hits a new record every year, every quarter, and they have great net income as well. And this was a one-time adjustment. You really look at the operating profit, because that excludes that little one-time adjustment. So the year-over-year comp, this is what you really want to look at. This is the before-tax number, so you basically will remove another 15%. But they just had a record profitable quarter of $52 million. They netted on that $45 million, so they made $45 million of net income just this quarter. Let's go see how much the dividend cost exactly. That's what we like to do here. The dividend cost literally $12 million on the very bottom left. If you're wondering, hey, then why in the middle does it say it cost $37 million that one quarter? Because they frequently do special dividends. You rarely see that with companies. If you look at like the 4th most recent payment, they did on top of their normal 12-cent dividend, they did a 27-cent special dividend because they have so much extra money, they don't know what to do with it. So anyway, that's kind of a cool thing about ClearSecure. They also do buybacks. I should have shown that too. But anywho, they're a little expensive at a 31 forward PE, but I collect a nice little dividends with that one. Ooh, Caterpillar. That's one of the stocks that have been booming recently. A lot of infrastructure stocks have been booming, like a United Rentals, a John Deere, a Caterpillar. And Caterpillar, if I own this stock, and check out how good it's done. It's at an all-time high. If I own this one, I would not trim or sell this company because, in my opinion, I think it's going to continue to climb higher. Check this out. The forward PE is a 30, so it is kind of like the risk reward isn't great buying it here. But even if you buy the stock right now, you get a 1% dividend. They have a very safe 25% payout ratio. The valuation, the forward PE is expensive because the stock has gone up so much, So a 30 forward PE, they're in energy transportation. They're very nicely diversified. So a lot of their customers are energy and transportation. Then they're in the construction, these huge construction Caterpillar, machines that we see. And the resources, so like, people trying to get resources out of the ground use them. So let's see. Caterpillar expands NVIDIA partnership to integrate AI technologies across operations. Caterpillar launches Cat AI Assistant. So looks like they're getting into AI or stuff like that. Anywho, they print money easily over 2 to 3 billion of after-tax net income a quarter. And it is down year over year, but is expected a massive rebound. They had a massive beat this quarter specifically on earnings. Check out the orange line. That's kind of what the analysts expected. They expected 16.7. They did 17.6. And the EPS they expected was 438. They did 488. And on the EBIT, so not even like this was some one-time adjustment. This was really real. Like the earnings before interest taxes had a big beat. So anyway, Caterpillar's a beast, just like United Rentals. Oh, I almost want to go over United Rentals right there. It's such a good stock. And my bad if I'm a little behind on the chat here. I want to go over strictly some dividend stocks because I'm gonna upload this as a video later, and then right after this we'll get into some of y'all stocks. So I just want to go over United Rentals really quickly. Now this one has had a massive rebound the past couple of days, but I put this one on your watch list if you're just looking for a very shareholder friendly company. If we go to their net income, they're easily Actually, a better way to look at this is the EPS. So the dividend is $1.79. Here's another simple way to do a dividend payout ratio. So the dividend is $1.79 a quarter. And here's what they make in net income a quarter in terms of EPS, $10.90. I mean, on average, this company's always making like basically $9 to $10 of EPS a quarter. That's net income per share. There's another cool metric called the free cash flow per share. And check this out. They make $18 to $20 of free cash flow per share a quarter. And the dividend only cost $1.79, added this 18, added this $10. So if we go to their net income, they're easily making like 700 mil of net income a quarter. How much does the dividend cost? Literally only $115 million, only $100 million. And since they have so much leftover money, my favorite part about this company is the share buybacks. Check this out at the bottom here. They did $600 million of buybacks just in the most recent quarter, a record buyback. They're always buying back $400 to $600 million of like their own stock. And they've done that for all of eternity. You know, even back to 2021, they spent hundreds of millions of buybacks. So if we go to the total common shares outstanding, like if we just go back to 2021, there were 72 million shares. You kind of see that there were 72 million shares. Now there's only 63 million. And whenever they buy back their own shares, that makes the EPS go up, gives you more ownership in the company, makes the dividend costs go down. So this just has the DNA of a multi-bagger, in my opinion. At a 23 forward PE, it's not crazy expensive. Like it could stretch up to like a 25, a 28 forward PE, in my opinion. So that's why I do own United Rentals. I am biased. Nick said Visa stock. You know what? Let's go over Visa because this is a great one, in my opinion. One you can't bet against. And you know who actually owns Visa is Nancy Pelosi. If we go to the Nancy Pelosi portfolio right here, the Nancy Pelosi portfolio, here's kind of how her portfolio has done. But yeah, one of the stocks she owns is Visa. This is another great stock to buy, never sell. I think if you buy the stock even right now, you should still get S&P 500 type returns, like 8% of your money back a year, because they're so growthy. But yeah, the forward PE is like, here's why. They're not expensive on a forward PE. They're trading at 27 times next year's PE. That's super fair in my opinion. If we go to their net income, this is what's crazy. They're easily making $4.5 to $5 billion of after-tax net income a quarter. And what are they doing with $5 billion of after-tax net income a quarter? Well, the dividend only cost $1.15 billion, but the buybacks are the winner here at the top. This is why the stock doesn't go down. They do $4 to $5 billion of buybacks a quarter. That's the best part about Visa. They're so shareholder friendly. Let's get to Mo right here. This one is another one you kind of buy to maximize your dividend income. You know, the stock is the same price that it was in 2016. So you bought the stock in 2016. It's the same price that it is today. But they paid you every single year a qualified 7% dividend. And maybe if you bought it even lower, you got like a 9 or 10% dividend every year in qualified dividend. So yeah, they have a 7.12% dividend yield and a safe 62% payout ratio. Let's go do the math for ourselves to see if the dividend payout ratio really is safe. So this quarter they made $2.3 billion. I know they had a one-time adjustment right here. It says they only made $1 billion, but they really right around their normal $2+ billion. If we zoom out, they're always making over $2 billion net income a quarter. So they made $2.38 billion exactly the past 2 quarters. Let's go see how much the dividend cost. The dividend cost at the very top here, only 1.72 billion. So as long as they're making over 1.72 billion a quarter, they can afford the dividend, and they can certainly afford the dividend. Since they have so much leftover money, they're even doing buybacks. Check that out. They're doing a couple hundred million of buybacks at the top here. 2024, they had a big acquisition or big buyback. They have a bunch of positions in smaller stocks. Like I think they have a big, oh, they're down bad, super bad on this investment, but ticker symbol CRON, and a couple of yeah, Altria is the largest shareholder. They own 40% of all the shares. What was the other? What's the Anheuser-Busch?